Okay, so real quick, I don't have too long, but I'll discuss real quick about someone was asking, I guess, more to elaborate more on just swinging and scalping in general. And so let me start with this. If you are, you've got to be careful with scalping. And number one, I think that people should focus on swing trading more than scalping. You know, if you listen to Al, you've heard him say he's a scalper, but what he mentions quite frequently is that he's always looking for a swing. For example, he sold below this bar, ended up probably scalping out. Now, very often he'll take a swing and scalp part off and swing the balance. But he was going for the high of the day in a strong bear breakout. But when this happened, he probably scalped out. So, anyways, number one, I think swing trading should be the cornerstone or the foundation for anyone's trading. No, I don't believe any really good trader, and I don't want to say that because I'm sure there are some people who can do it. Uh, let me restate it. I think that most traders who scalp are not intending to take only 1 point scalps or 2 point scalps on every trade. So, for example, such as such as this. Let me go to the E-mini, but if a trader, let's say a trader shorts below here, first swing, well, more likely than not, they're going to sell here and, they're probably going to go for a swing. However, when they see this bar, they may end up scalping out. You can see at 550, price clearly went, almost low enough for 2 points. A lot of bears were taking profits at 1 point lower or so. So I want to pause right there and kind of back up. Number one, my primary foundation trading is always in. I like always in because I think it's a very solid. It gives you a very solid grasp of the market cycle, if you will. So in other words, I talk about always in every day, and thanks to Al, Al helps with that. What I mean by that is, I learned that from him. I still learn it from him. So in a strict swing trading sense, if we were strictly just swing trading here, always in has many different ways. So before I go into just a strict swing trader, how they would view this day, always in, there's many different forms. Always in simply means that, at this moment from, anywhere over here, the market is always in long. So bull breakout, clearly always in long. It just means that you're better off buying than selling. That's the only thing always in means. So, a strict always in trader would technically just, they would sell below here, probably get out, maybe above here, maybe above this bar, and, technically they got to get long because the market's probably not always in short anymore, so they probably got to get long. Maybe they get out below, but if they do, they got to get long again, and they hold, they get out, maybe they go short here, but then they go long here, and then they hold for the rest of the day. Here's my issue with it. I think that's great. It's a very sound way to trade, but it's a lot of thinking, and it doesn't yield a lot on a trading range. You're going to make a lot more by selling, scalping out, buying, scalping, buying more, scalping, you know, buying this close, scalping out, buying this close, scalping out, buying this close, scaling in, you know. So before I get into that, always in is great on a day like yesterday. You know, a strict always in trader, they're gonna, I gotta even just so I can see the bars. They're not gonna short anywhere. They're not gonna do anything here. They're gonna probably start looking to buy. You know, if they don't buy here, they'll buy here. So they're gonna buy, put their stop here. And let's just go let's go every bar. If you're swing trading, you're going for a reward twice your risk and you're willing to hold through pullbacks. If you're really trying to truly swing trade, you're gonna hold long until it makes sense not to hold long. But I don't think most traders don't do that. You know, ideally, you get a couple months, couple days in a month where you get a just relentless move, and you're gonna make a lot if you hold the whole move. So kind of like here, you're no reason to get out. We're still holding long. Again, no reason to get out. Stop maybe down here or down here. New breakout, stop down here. No reason to get out. You know, still no reason to get out. Maybe stop down here. No reason to get out. You know, maybe you get out below that bar, but otherwise stop down here. And, you know, if you did get out, you get back in above a bull bar. So, again, it's difficult. You know, I mean, really, this is a micro channel, so I really don't think always in bears would even get out here. Always in bulls. And, you know, do they get out? Maybe. Parabolic, first push, second, third, so parabolic wedge, consecutive buy climaxes. This is extreme, but really no reason to get out. And, you know, at some point, they probably get out here, certainly on that close. So let's think about that. You buy this close at 22.05, you hold at till 22.30. So you make about 25 points on the day per contract. Well, like I said, most days don't do this. Most traders, what they do is they do this. They buy, scalp. So in other words, what I like to do, which is partially why I like trading smaller, and by smaller, I simply mean I like trading, you know, I think it's why one reason a lot of people, that's why I recommend, I think most people should trade Forex, or if they can do it, trade stocks, day trade stocks. And the reason why is it's very easy to manipulate your position sizes. So, in other words, always in long, buy the close, stop down here. And, you know, let me put it this way, a lot of swing traders do both. They scalp and swing. So, in other words, you know, a lot of always in traders do both. You know, they use always in to determine what they should do, but they do a little bit of both. So, for example, you know, why are there tails up here? It's because bulls are scalping out. So bulls buy, maybe they take part off. You know, so here's how I would do it. Let's say you're starting out, and you know, I think one easy way for traders starting out is to have a full size and half size. So, you know, maybe that's for someone starting out and they're trading the spider, and once again, the spider looks the exact same as the E-mini does. So I would trade a half size and full size, both starting out. And what I would do is, you know, I'd buy, maybe I buy this close, stop down here, or buy this close, stop down here. Take part off at, you know, 20 cents or 1 or 2 points if you're trading the E-mini. Then price pulls back. Well, you know, that always in bulls hold long. So if your stop's here and you know always in bulls are holding, buy more. Bulls, there's an advantage to scalping because you're locking in profits and it allows you to buy more. Most days you'll make more because you buy, scalp out, part, put the rest of your position back on, stop down here, scalp out, part again. If you can, put the rest of your position on, stop down here, scalp out, part again, and you keep part on. That way you're at least catching the move. And, again, you have part on, part on still, maybe but it'd be difficult to put your full position back on. So, that's the problem. That's why I was saying that traders who buy and just hold this whole move up, they're going to make a lot more than someone who is buying and scalping out. Now, let's take today. Okay, so a trader might sell, scalp out part at 2 points or 20 or 30 cents in the spider, and they get out of the rest here. Well, they basically, ideally, they'll lock in some profit and they'll make more. Maybe they buy below this bar. Maybe they buy part or a full position here because it's always in long. They buy this low, stop down here. They take part off at above this high or 20 cents. Price pulls back again at the moving average. They buy again. Then they scalp out part. Stop still down here. Second entry short. Maybe they get out of longs, but if they don't, they buy back the part they scalped out, and maybe they scalp out again. Maybe they buy again. Maybe they scalp again. And same thing up here. They buy this close. They scalp out. Price pulls back. They buy their position, half their position back. Scalp out. Price pulls back again. They buy. Scalp out part. So you see what I'm saying. In a channel, that's why a channel happens. In other words, let's find a broader channel. The tighter something is, the better off you're going to be just holding. Kind of like these moments. If you sell this close, put a stop up here, you're better off. It's okay to scalp out at 10 cents or 2 points or 1 point, but you're better off going for a swing, so going for something like this. However, once you start to see sideways movement, bears are taking profits. That's why, when you get this close, price goes up. So at this point, it goes into the 90% of the time you can buy or sell for any reason and make money. 10% of the time you see this and it's very, very difficult to make money going against the market. So what do I mean by that? Well, what I mean is bulls over here, we're back getting close to 10%. So, let's say you get this bear breakout. Well, bulls are going to buy, scalp out. Bears who are short are going to scalp out part or all, sell more or add on to their position at the 50% pullback, scalp out part or all. Maybe they sell again here, scalp out, as opposed to holding, getting out here. There's the same. That's why I think understanding always in is extremely important, because if you do understand it, then you can start to sell, sell more, start scalping out, or maybe you take your profits on the way down. One thing that I think is a great method is get a breakout, take part off at the measured move down, or take part off at 3 or 4 points down, or at the close of yesterday. Take part off. I think the biggest problem two things. I'm gonna beat it to death, but I'm gonna keep talking about it, and hopefully it'll get people's attention. Trade small. If nobody wants to start out and trade 25 shares or 50 shares in a stock, because if you do that, then you're not going to make a lot. Well, but you know what? You can really get to a point where you don't care. And if you add up the little pieces, 25 shares in a lot, but if you're trading 250 shares and you're making 70, 80, 90 cents a day, it's $175. If you can get consistent with doing that, you can do pretty well. But anyways, back to always in. It's a great foundation because you know that number one, bull breakout, climactic, we may test the low of the day. So always in bears, always in bulls get out. They definitely get out here. So expect a possible give up situation, so you sell. But if you don't understand always in well, it's easy to make the mistake of buying this low, and then you get this. So I would really practice, if I was starting out, trading always in. And then once you get a better and better grasp at it, practice scaling out a profit. So what do I mean? I mean, you buy this close, bull breakout, maybe, you take part off or, whatever. And then maybe you get out somewhere up here, bear breakout, sell, stop up here, hold. Maybe you think, okay, best looking bear bar, so I'll take part off. Stop's still up here, so stop's very far away. And then, another bear breakout, take another part off, or, just wait. But, tight channel, probably sellers above, which there were. Bears will probably be able to get out here. But here, you get a double bottom, and always in bulls will buy, and always in bears get out. So if you're holding short, it's best to get out here. But, in terms of scalping, I really don't like to scalp counter trend. I've begun to take more scalps more and more frequently. But what I mean by that is I'm really just scalping always in. So let me look at another day real quick. What kind of like here, you buy above, maybe take part off here, or part or most off here, bear breakout. Maybe you just get out of your total position. And if you sell, maybe you take, part off 20 cents lower, and then, you get out. And to me, most of the time, it helps with locking in profit and, just reducing risk. When you see this many bars up, the best thing you can do is buy more, buy again. But, I've never honestly tried that. I hope I will one day, but that's a little too, that's a tough thing to do. But if you can do it and do it right, you buy, you keep building your position until here, and maybe you get out below there. It's very profitable. But, in terms of swing trading and scalping, I think most people, when they think of scalping, they think of, here's why most people scalp. It's because I think when people starting out, there's a natural tendency to want to reduce risk. So, when they see the fourth bull close in this rally, they know the stop's down here. But they're thinking, this rally it's 10 points. I don't want to risk 10 points. So what do? They start looking for shorts. And then they miss this whole move up. So to give you an example, this is the power, this is what, so you give yourself such an advantage by trading small or having the ability to, is you can just put on, a fifth of your position or half your position, normal position. Just buy at the market, put your stop down here. And even if you're not at a full position, you're at least riding the move up. So, a lot of traders starting out, they make the mistake of saying, okay, this moves too much, I'm going to sell this high. And, what they end up doing is they end up not using the right stop. They end up, getting out somewhere up here, or they sell this high, scale in, realize they're in too big of a position, and they don't hold, or they don't do the right thing. A better example is selling this high. That's an okay thing to do, but the traders who are selling this high have their stop up here, and they're going to sell this high. They may sell 2-3 points higher, sell a 50% pullback, or sell anywhere, but their stop's up here. So I would not worry about counter trend until, I think it's always in short here, so I think it's much more reasonable to start selling above bars, stop up here, betting on a second leg down. But I would not, the main thing I would focus on is working on, when you see stuff like this, buy at the market, stop down here, and just, Al uses the analogy of jump off the high dive, pinch your nose, close your eyes, and eventually you'll be in the water. But just buy, stop down here, and just hold. And you think, first reversal down will fail, scalp out. So, maybe you get out below here, I would definitely get out below this bar. But that's what I would do. By the way, for this, well, hang on. Maybe it's, no. Maybe it's here. Okay, that's kind of interesting. What I was looking at, a lot of times these pullbacks, they happen for, several reasons. Most obvious, bears sell here and, sell more below bear bar, get out break even. Anyways. So, my main question for this particular person is, or anybody that's asking about scalping and swing trading, is if you were only getting, well, number one, are you profitable with what you're doing? And if you're scalping but you're not profitable scalping, you need to lean towards swing trading more. It's just because the potential is a lot greater, and a lot of times with scalping it requires, scaling in. So that'd be my first question, is are you profitable scalping? Second, my next question would be, do you often miss these kinds of moves? What about yesterday? Do you often, if you're watching the E-mini, do you miss these strong rallies? And you look back at the end of the day and you say, oh my gosh, if I would have just bought and held, I'd have made 10 or 15 points. If you're missing those strong rallies and at least not getting pieces, I would focus more on swing trading. The reason why there's a common tendency to want to scalp because most of the data is this. Therefore, it's a lot of work to buy, go short, buy, hold, and, just sit through a lot of sideways. And it's much more effective to buy low, scalp, buy lower, scalp, buy, scalp. But I would really work on swing trading. And, so yeah, I don't really have, as far as the difference between scalping and swing trading, there's a difference, but I like breakouts. That's my favorite, and I know it's Al's favorite too. Where you get, it's more of a tight channel, but it kind of works. You get 4 consecutive bear bars. You buy this close, put your stop down here, and maybe you take part off at 4 points or 2 points or 20 cents, 10 cents. By the way, 20 cents is 2 points in the E-mini. I see stocks as most of your stocks, the minimum scalp's about 10 cents. So I kind of see it as 1 point in E-mini. And 20 cents is 2 points. So, so the first thing I would say is I would practice always in. I'd really, really practice understanding always in. And especially if you're happy scalping, then, even if you miss these moves, but you get plenty here, then by all means. But I just think the math is really good for traders who can sell this close, maybe take part off here, or sell more, or better yet, just they can hold. If you just look at always in, you sell here, you sell this close, you get out above. So let's look at always in on this day. Bar 1 probably always in short, but big gap up. If anything, I would sell, stop above, better, but okay to wait for another bar. Clearly always in short, probably going down for a measure move, but first left should fail. So if anything, I would sell this close, put my stop up here. But bears are starting, looks like bears are scalping, so it's okay to take partial profits at the moving average. And, the risk is big and look to sell higher. And that's exactly what traders were doing right here. So, but still always in short, no reason to get out. Stop up here. The stop probably changes. Probably 3 bars down, it's safe to probably move your stop. Here, consecutive sell climaxes, you're at the low of yesterday, back into this range. You're at this higher low. This is yesterday's low. But back into this range, I think it's okay to get out. But again, there will probably be bears who are selling above. So if you do get out, you've got to look to get short again, or wait for a couple bars up. So again, kind of my point. Second entry buy, we may have a deep pullback, so I think it's okay to get out. And you can see we're starting to get a lot of tails on bottom. Looks like a final flag, low too short. So if we break below, this we'll probably have to come back to these highs. So here's an example. This is kind of interesting. You will have bulls buying here, going for a swing, and I don't know how big the price scaling is. I'm not really paying attention to it, but let's say for these bulls will probably buy this high and look to buy 4 points lower, 5 points lower. So what they would do, most bulls buying here are not going to put a stop down here. They're going to use a wide stop and buy more above a bull bar. So they'll buy a half position and then another half position. Probably a bear flag. The bear's probably selling below, but again, tight channel. And at this point, you call it a wedge, nested wedge. I think it's okay to, before I say that, still fairly low in the channel. These traders are selling above bars. You got to always wonder about the potential of a bull breakout, such as there. I'd get out. So if I sold here, theoretically, it never went always in long. So bulls that are buying probably get out below here, and the bears probably sell. Maybe stop up here, stop above here. But if they do sell, they probably got to get out of the shorts and go long here. Surprise breakout. So back up into this high, but now here's the issue. 50% pullback. And I know I'm saying a lot, but I'm just trying to, this is how, I want to pause. Always in kind of evolves. You know, a lot of people, you know, I give the analogy of this. Okay? If you know that, well, I'll put it this way. You know, if you know, I wouldn't do it there, but let's say right here. If you know there's going to be sellers above and you're short, why not sell more at this high, knowing you get a little bit? So, you know, it's kind of like you see this big tail, so you buy back your shorts. Well, you know, probably sellers above, so you sell here, scalp out. There's always little pieces, and you know, the more you trade, I think the more you start to see little things of ways to lock in profit. Anyways, back up here, 50% pullback. So first thing I'm thinking is, okay, big up, big down. You know, maybe we get up to here, but I don't think we'll get to the high of the day. You know, tail, we're at the top of the channel. This is the 50% line. What's the follow through going to look like? Bear bar. So I think this gap's going to close, and you know, going up, but you know, I hard to say. Would I be long up here? You know, I think you can. I think it's better to buy a pullback or buy a small position and buy lower. But if I had to pick anything, I'd be long. Stop down here. Bears probably needed one more bar. They got their one more bar and clearly backed always in short. So, you know, again, that's what I was saying just a few minutes ago about the 50% pullback is, you know, it's difficult. And, you know, but again, here, probably back to always in short, but looks like a trading range. Deep pullback stops down here. You will have bulls who are buying, trying to get out up here or break even. And, you know, at this point, bears who were short, well, let me back up because I'm going to go fast if I don't. I say always in short. And the reason I say that is we'll get a second leg down. Big tails, so the reality is, let me delete some of these lines. So we know that was 50% pullback. We know that yesterday's close here. We know that the stop for the bulls is here, and there's tails. So the bulls are going to start buying because we're low in the range and scaling into the position. They're managing their trade. So yes, sellers above, and if the bear sells, they made money. So they sell this high, 26.75. They sell more. Well, actually, yeah. Well, they could have made 1 point. I think always in bears get out, and we're probably back to always in long. And the bears probably didn't do enough to make it always in short. And back to always in long. But again, bad follow through. So I think it's okay to get out. And you see, this is where always in becomes very difficult. So, you know, it's kind of, we're holding above this moving average, the 60-minute moving average. You know, so it's kind of one of those strong enough breakout for a second leg up, but clearly bears are failing to break above. Theoretically, the bear stops up here, so, you know, maybe back to always in short here. I don't know, you know, difficult. But regardless, this looks like a leg in a trading range. So bulls are probably buying, scaling into positions. And look what happened. We broke to new low. So you may have trap bulls, but either way, it's always in short, tight enough channel, second leg down. You know, I'd probably get out above that bar. But again, probably going to have to retest and got another bear breakout. But so there you have it. In hindsight, leg 1 pull back, leg 2. Came close to it. So, always in, it's a great way to get a basis of price action, but it's tricky. So that's what I would work on. I have a lot of videos about always in. That's kind of what I focus on. All right, I'm running out of time, so I'm going to end this video. Thanks.